Let's go ahead and begin this educational and informational session for the Mishawaka Common Council regarding tax abatement, TIF, the consolidated TIF cash flow, and any other valuable information that our friends from the administration wish to share with us. This evening's meeting is being live streamed. So we welcome those who are in attendance virtually or who will be watching this via recording. We also want to welcome and acknowledge our friends from the Redevelopment Commission who are here with us this evening. Good evening to you as well. And with that, unless there are any additional questions or comments from the council, why don't we go ahead and turn the floor over to Mr. Prince, and he will lead us through the proceedings.
Thank you, Mr. President. Can everybody hear me okay? I know the microphone location, is that?
Right now, I'm not picking up any audio.
You're not picking up any audio. So IT, we'll give them a minute to see if.
Sure.
Testing.
Nothing.
Yeah. Testing.
I can hear it through the speakers in general, but nothing up here. But why don't we go ahead and move forward, and hopefully the IT will catch up with us.
Very good, Mr. President. As you mentioned, we have three components to tonight's meeting. First is entirely informational on tax abatement, tax increment financing, and the consolidated TIF cash flow, where we go over projects and how we look at the cash stream coming in, and then really have identified priorities moving forward, unallocated, but priorities moving forward. So we do have our friends from Baker Tilly here, and they will be presenting the portion on the tax increment financing component. I'm going to be leading off with tax abatement. So with that, tax abatement. So again, this is an educational session, so I apologize. Those of you that have been here for a while know exactly what tax abatement is. Those of you that are newer may not know what tax abatement is. So essentially, tax abatement is a phase-in of new taxes on new assessed valuation. So that's very important, and we'll talk about that as we move forward. But this is all new taxes. This has nothing to do with an existing building and existing taxes associated with that building. It's all about the new based on development or purchase of equipment that would be going on a specific property. So there are two types of tax abatement: real property and personal property. As you can imagine, real property means new buildings. So Lippert, when they bought the building over on Bendix? Burkett, thank you. When they did, it goes all the way through for the record, so that's, yeah.
Point well taken.
Yeah, okay. So when they purchased that building and they did the building and improvements to the building, that's real property. The machinery that they put inside that building is the personal property. So you would have two types of abatements for one piece of property and potentially one project. And that was really set up for industrial type development. And also, as a general note, I didn't spend a lot of time referencing the Indiana Code, but all of this, there is roughly 60 pages in the Indiana Code that deals specifically with tax abatement, so I put the citation up there. For those of you who'd like some late night reading, you're welcome to pull out the Indiana Code and take a look at those 60 pages. But this is just an overview of tax abatement. So how does Mishawaka do it? This has been some discussion lately. As you may know, St. Joseph County had a proposal to redo their tax abatement process that was recently tabled. And the comment was made at that meeting that they wanted to be more like Mishawaka, or those that were looking to amend the process wanted it to be more like Mishawaka. So what does Mishawaka do? Essentially, we do not have a separate tax abatement ordinance. Other communities do, and they've spent a lot of time on methodically laying out, and the point of having an ordinance is to try to be fair. So let's say what factors you want to include, the amount of jobs, what those jobs pay, whether it's in a redevelopment area or not. And there's literally thousands of factors that you could use to establish a point system that would then award a higher or lower abatement accordingly based on that point system. In Mishawaka, we've chosen to do it differently in terms of looking at each property individually. So there is no way for our staff or anyone really to write an ordinance that can accurately include all the different considerations that you would undertake. And so the example that I use on Lippert, Lippert was a good example where you had an older industrial building, and we were very blessed that they came in and spent tens of millions of dollars to improve that building, because otherwise that could have ended up as another self-lock storage unit. So in that case, because of the condition of the building, how it had been used, and the investment being proposed, we gave them a very large abatement, a 10-year abatement associated with that piece of property. There isn't an ordinance that we could write that would have all those parameters. So essentially, we looked at it individually and came up with that by working with the council, working with Lippert, and trying to encourage that redevelopment in that building. So again, we do it project by project based on the Indiana code, and that's how we do it. So we don't have an ordinance. We only do it looking at it property by property. Our tax abatement applications. So in the back of the room, there are handouts. And one of those handouts is our application that we require every applicant to submit as part of their request for the tax abatement. A little over 10 years ago, we essentially borrowed or used as a template what Indianapolis used at the time. And the reason we did that is previously our application was only a couple pages long, and we were getting a lot of questions from the council regarding, okay, what type of goods are you established? What type of jobs are this? Can you break them out by classification? What is that? And what we found from the Indianapolis application was that it did a good job of answering all the questions that we were receiving from the council to have all that information. And that application is roughly 6 pages long, and that's in addition to the SB1. So another state form that you have back there that was given to everybody as a handout is the statement of benefits form that's required to be submitted as part of every application by state law that each application fills out. So when any developer or business would request a tax abatement, they fill in that application, they fill in the SB1, and they have their filing fee, and that's what they submit to the city for review and approval. So as I indicated, our ordinance, we just look at our past history. And considering our past history, another handout that's in the back of the room, we've approved a total of 66 projects for abatement since 1986. That's roughly 1.7 abatements per year. That's not very many. And if you look at that, I think what's really interesting is that we only have 3 active abatements right now. So when you compare us to other communities, the city of South Bend currently, when I reached out to them based on the reporting, so this is a year in the rears, had 23 active abatements. That was reporting for 2022. And St. Joseph County, talking to the director, currently has 10 active abatements. So roughly, when you look at Mishawaka, we are disproportionately low on the number of abatements that we give typically. So abatements only impact taxes on new assessed valuation. So I think it's very important to say, as it says in the middle of the screen there, abatements do not take away any existing assessed valuation from any other taxing unit. So because this is all new taxes coming in, when you talk about I'm worried about, let's say, the impact it's going to have on the school system, it really has no impact on the school system because this is all new added value. It does not take away any of the existing assessed valuation from the school district. So, and then the last point that I'm making in this slide is abatements can't be used to reduce taxes on existing assessed valuation. It's all value added. And the reason I bring that up is we had a project, a developer reached out to me. He bought an existing project in Mishawaka and was saying, hey, isn't there anything you can do to help me? Can I have an abatement? And my comment was, well, what is the improvement you're looking to do? And what they said to me was, no, the prices are just out of whack right now in terms of the rent that we can charge based on what we purchased the building for. We're looking for help in order to maintain the property. And I had to comment that, well, no, there is no way for us to help you. That was a business decision. Abatement is only on that new assessed valuation. So if they aren't planning to do an improvement, there is nothing that we can do to help them in terms of their existing tax bill. So per state law, and this gets very confusing, and I apologize for it, but there are certain uses that are identified in state law that you cannot give an abatement to. That includes golf courses, a country club, massage parlor, tennis club, skating facility, racket sports, hot tub, suntan, racetrack, packaged liquor stores. There's kind of a theme there in terms of what they want to not give an abatement to. But then they also go on and say, identify where the primary use is retail food and beverage, automobile sales and service, other retail, and there's an exception there, except where it is in an economic development target area. So you can do it, but you have to go through the extra step of identifying it as an economic development target area. And then you can also do abatement. Residential uses by statute are identified in the prohibited section, but you can do it under certain exceptions, and one of those exceptions is being located within a tax increment financing district. So you can give residential properties an abatement when it's located in that tax increment financing district. And again, I believe it's also referring to an economic development target area as well. So again, if you want to do an abatement in a residential area, you can do it, but there's a process and extra requirements that you have to go through in order to do it. So how is a tax abatement approved? It's a common council process. First, a declaratory resolution is followed by a confirming resolution, so it's a two-step process. Once the declaratory resolution is approved, the clerk provides public notice to other taxing units. So this is not done in darkness, if you will. So literally, notice is provided to other taxing units. If they had an issue with a tax abatement, they have the ability to come forward and bring it. Since I've been with the city in the 23 years, I don't believe any other taxing unit has ever come in and commented or expressed concern regarding an abatement moving forward. The other thing I would note specifically with the Redevelopment Commission is if the area is located within a tax increment financing district, it also requires the approval of the Redevelopment Commission. So the reason for that is if, for example, you're relying on the tax increment financing to pay off bonds or to pay off debt or do improvements, the tax abatement would essentially then be taking away the revenue that you're expecting in the tax increment financing district to pay for potentially the debt that you have, which is why that step is needed. So how do you start the process? As I mentioned, you file the application to designate the property as an economic revitalization area. That's the declaratory resolution. The revitalization area is area within the corporate limits. We can't grant anything outside of our corporate limits. But in the state law, it identifies that area as being undesirable or impossible of normal development and occupancy. And I would use the same interpretation that we I don't want to say stretch, but in terms of many communities have different standards regarding what meets this definition. For example, when the original tax increment financing district was established in the city, which required it to be a blighted area, the definition the city used was identifying that needing to provide utilities and improvements to that area as being blighted. That was the connection that made to the TIF that allowed it to become essentially a blighted area. So I don't look at Main Street and Grape Road necessarily as a blighted area, but it was an area at the time that needed infrastructure extended to it, which is how it got established. Again, it applies to real estate, and it is transferred with the sale of the property. So if you designate an area and somebody comes in and buys it, that designation stays with the property for the period of time that you've designated and would go to the next property owner. So as I indicated, the declaratory resolution establishes the ERA, but that does not approve the abatement. So you can approve an entire area as an economic revitalization area, but the confirming resolution is what you're voting on regarding approving or not approving an abatement. So just because you're in an economic revitalization area does not necessarily mean that you're going to get the abatement. That's the two-step process. So the confirming resolution actually approves the abatement and also defines the parameters of the abatement, specifically the length of time of the economic revitalization area, the number of years of the abatement, and the percent of new taxes that are being abated per year are all identified in your confirming resolution. So those are the items that you want to look for. The declaratory, you're just establishing it that this meets the definition and you want to put it in the area, but the actual abatement, you're determining those three factors. So the economic revitalization area, that has an expiration to it. Essentially, to be eligible for an abatement, you have to complete your improvements within that period of time. So one of the recent projects, a member of the council was on when we approved the abatement for Steelhead Apartments that was just requested, essentially rescinded or removed their abatement. We thought one of the benefits was dealing with the old Lincoln Highway Inn, or Mishawaka Inn, whatever you want to call it, that the benefit was to do it quickly. So what we did on that economic revitalization area is we gave a short 2-year window in order for them to not only file, demo, and then complete their improvements on that property. If they didn't complete it within that time, they wouldn't be receiving the abatement. So literally, that abatement, that economic revitalization area, was expiring at the end of this year, and they haven't even started the demolition of the project. So if they would have started the demolition, there would be very little increase in assessed valuation that would have occurred by the end of this year, which is why they took the step to withdraw that application. They were going to get no benefit from it. But that was part of our consideration of making that recommendation to the council of keeping that short window on that abatement. The other thing to note is projects can span multiple years. So a 5-year abatement, so using Steelhead Apartments as an example, they have a 2-year window in order to construct the improvements. So you could, after the first year, have a partial assessment that then is abated for 5 years. And then the second year, you have the balance of the assessment that then is abated for 5 years. So that abatement, that 5-year abatement can last and have reporting for 7 or 8 years or longer, depending on how you've set up that economic revitalization area, the length of time it takes to complete the project, and then the reporting required based on when the assessed valuation was created. So a standard abatement by state law is between 1 and 10 years. Typically in the city, and this predates when they modified state law, but it used to be you would only give a standard 3, 5, or 10-year abatement, and we've kind of stayed within that rule. And then in 2015, they created an enhanced abatement, and the state would give you a lecture on, some people call it a super abatement, but a super abatement is 100% over a 20-year period. Is they're not a definition of super abatement, but they don't want you to confuse the terms of enhanced versus super. So an enhanced abatement only on certain equipment can be up to 20 years. So when you think of some of the, like the data center that is being located or proposed in western St. Joseph County, out by New Carlisle, that might be, I don't know what the county's doing, but I'm suggesting that that would be a project of a value that they might want to consider a longer than 10-year abatement for the project. And that's what that enhanced abatement process was meant for. So the length and percentage abated is determined by the council. And one of these things that we deal with when an applicant submits is we make recommendations to them of what we think the abatement, based on our history and our past experience, of what the council might approve. There are a number of abatements that don't even get filed because we say, you know what, it's not of the value, it's not the type of project, we don't think it would be eligible, we think it would be a waste of time to submit on. That's staff's responsibility. Of course, anybody, if they want to, has the ability to submit an application for a tax abatement and submit it for your consideration. But it's our job as staff is to try to, we don't want to send people down a path only to be met with resistance or like, why did you submit this? That's our job in terms of staff. So, but the length and percentage abated, and we dealt with this with the Avalon building when they came in for their abatement. They had originally wanted, I believe it was a 5-year abatement, and ultimately we recommended a 3-year abatement, and that was what was approved. But what I wanted to point out was that we don't even list on our application, there isn't boxes to check or a line to fill out regarding the number of years requested or the percentage. That is determined by the council. So they submit the request for an abatement, and they can say in the application and letter form what they're looking for, but we don't even have that in our application process because we ultimately believe it's the council's responsibility to weigh in on that. So. And also our thought is everybody is going to submit if you're eligible for an abatement. Well, let's check the higher box. So we don't want everyone to request a 10-year 100% abatement and then have to figure it out from there. So that just goes into our process. So again, standard abatements were previously done in 3, 5-year, or 10-year periods, and they were done in increments. So the 3-year abatement used to be 100%, 2/3 and 1/3, 5-year 180, 60, 40, 20, and the 10-year dropping in 10% increases. And one thing that we found out just in the last year, so I think this information all session is important because we haven't been able to get you an abatement in the last year since we found this out, but assessed valuation and tax caps greatly impact the value of the abatement. So the first thing to do is to talk about assessed valuation, and one thing we get charged with a lot is why is my assessed valuation going up, and that type of question. And as you all know, the city has absolutely nothing to do with determining assessed valuations. The assessed valuations are determined by either the Penn Township assessor or the St. Joseph County assessor based on the location of the project. And then there's three methods that they use to determine the assessed valuation, which is the cost approach, a sales approach, and an income approach on that property. And I'm not going to get into details on that, but they have methods to determine that it's not a random guess regarding how they determine the assessed valuation. Some people might disagree with me, but that is how they approach determining what the assessed valuation is for property. So specifically, assessors also use trending or sales close to comparable properties to help determine assessed valuation. And so when we were talking about Southwest Little League and that property, and people were concerned about Habitat going in, building $250,000 homes next to $120,000 homes, that has some validity, but it also means that ultimately, if they determine it, likely that you could also sell your property for more money, right? To be the lower value house in a higher income neighborhood is going to bring your property value up, but you don't want to realize that property until after you've sold, right? Or at the time that you sell. You don't want to pay property taxes on that. But in general, as a city, we want to continue to see those assessed valuations go up. We want to see the higher development and not have assessed valuations go down. We want to constantly see them go up. So that's what we're looking at. So as we all know, in Indiana, there's tax caps that limit the property taxes that are being paid. On residential homesteaded property, that's limited to 1% of the assessed valuation. That's essentially owner-occupied property. Other residential, which includes non-owner-occupied single-family residential and apartments, and agricultural property are limited to 2% assessed valuation. And then the other category, which is essential commercial and industrial property, is limited to 3% of the assessed valuation. The other thing to know is that different taxing districts have different rates. So the highest tax rates in the city are actually located in the school city of Mishawaka and the South Bend Community School Corporation areas because of the referendums, which are outside the tax caps. So there is no difference between the city and county tax bills for both the 1% and 2% caps. And this is why I shouldn't have Baker Tilly in the room, because they pointed out to me that the DLGF, the tax calculator that you have online from the state, does not include the lit replacement credit that is in the county that is not in the city. So it is slightly lower in the county, but I didn't want to bore you with that level. So from a technicality standpoint, I don't want to have them correct me, so I brought that up and I put that in the slide. But from that basic calculator that you find online, the owner-occupied homestead exemption, this is an example for a $300,000 assessed property for 2023, paid 2024, in school city, in the city, is $3,525 a year. City PHM is $3,000 a year. City Clay, South Bend Community Schools, is $3,581. And in St. Joseph County, the PHM district, located outside the city limits, that single-family house is also paying $3,000 a year at that 1% cap. Single-family rental and no home, or essentially apartments, in school city, that same $300,000 home or assessed valuation is paying $7,052 a year. In the city PHM is $6,000 a year. City Clay and South Bend Community Schools, $71.52. And St. Joseph County PHM is $6,000 a year. Now, where it gets interesting is in the commercial rate, because when you look at the county rate, there is still tax caps in the county at that 2% rate, but there is no tax cap. Our rate is higher than 3%. The county rate is just over 2%. So we are a significantly higher tax rate than what the county is, but it only impacts that commercial, that other category of commercial and industrial classification. So I'm using the AM General H2 Assembly Plan as an example, because also we're going to be talking about this issue when we talk about the comprehensive plan. So I wanted to use this as an example of development and types of development. So using both the AM General and the H2 assembly plant, that entire industrial complex, which is huge, that real property assessed valuation for both properties is only at $16 million currently. Probably has something to do with the one area being essentially vacant at this point in time, but that's $16 million. And the other thing to note that I didn't include the machinery component. So where, like on the residential side, you're not assessed for your personal property, like your furniture and things, that machinery and equipment is taxed, and that's taxed at the same rate as what the property is. So that does not include that. So I'm not saying that their assessed valuation totally is just $16 million. This is just the real property associated with that. So I don't want to confuse anyone more than I already am. So if that $16 million commercial or industrial assessed valuation is located in the city or school city, their yearly tax bill is $535,584 a year. In the city, in the PHM, they're at $480,000 a year. In the city and the Clay, the South Bend Community School Corporation, they're at $541,440 a year. And in St. Joseph County, in the PHM district, they're at $328,368 a year, or essentially $151,000 less than the corresponding city taxes that are in the city PHM district. So essentially, the commercial industrial taxes are 46% less in unincorporated St. Joseph County than they are in the city. So when you hear, and the other point that I would make is that any large development, there's many uses that don't require city utilities to be located on it, but many larger commercial, you don't see large apartment projects, you don't see large industrial users being located without the need for city services. So when we talk about the comprehensive plan in a few weeks, we're going to be talking about this very issue of how we want to approach annexation relative to the extension of utilities because of this equity issue, which is why we wanted to go over that as part of, we're only talking about assessed valuation, but we think it's an important seed to plant as part of our future discussion. And the example I'll use is $1 billion. So you look at what's happening out by New Carlisle in the data center. I wanted to put this in perspective. So, and I used Harris Township as the example because of the county's recent action to rezone property out off of Capitol Avenue. If you look at $1 billion of assessed valuation out there, in unincorporated St. Joseph County, their tax bill is a little over $20 million. And in Mishawaka, in PHM schools, it would be $30 million, or basically a $10 million difference a year based between the city and the corresponding county tax rate. The other example I want to use is just how abatements work. So I'm going to try to go through this quickly. But abatements only impact new taxes. So the yellow property that I've highlighted that you see on the screen is the 112 building, the office building down by Buter Park. And what would happen if you built a new 40,000 square foot office building that's indicated in the orange square next to it? And I use this property specifically because we don't have any current proposal for it, but it puts it in perspective regarding what we're talking about with taxes. So you would have an estimated $12 million construction cost. That's $300 a square foot for that 40,000 square foot building. Roughly, and I use this because I'm not the assessor, I don't determine the value, but if you look at like the mill building that's immediately across the street, their construction cost and their assessed valuation is roughly 80% of the construction cost that they incurred. So I used 80% as the number for this new construction, which puts the assessed valuation at $9.6 million. And the standard thinking is, okay, so you have commercial assessed valuation with a 3% tax cap. 3% of 9.6 million is $288,000 per year. The existing assessed valuation is $3 million on the Ironworks building, so that office building is currently being assessed at $3 million. So 3% of $3 million, again, you don't change that as part of the abatement process. So that tax continues to get paid. They're paying $90,000 a year on that building, and their total tax bill without an abatement for those two projects together on that property would be $378,000 a year without the abatement. So what would a standard 5-year abatement look like in terms of those reductions going from 100 to 80 to 60 to 40 to 20? So if you take 90,000 plus 100% of that 288 taken off, you're paying 0 on the additional, and then you phase it in 20% at a time. What it ends up being is 1.03 million taxes paid in 5 years. That compares to, again, 90,000 times 5 is only 450,000. So you've achieved over 550,000 of new taxes that you wouldn't have had before without that building going in. So, and you would have abated roughly 864,000 in that 5-year period. So what we didn't know, and what I started talking about earlier, was last year we were contacted by a developer looking to do an industrial development, and they pointed out to us, well, the impact of the tax caps are significant relative to the percentage on the abatement. So let me go into that and explain it. So the reality of it is, for commercial, the tax abatement is independent of the tax cap, so the owner only gets the benefit of the lower number. So based on a $9.6 million number, the assessed valuation without the tax caps is $419,981. That essentially means the tax cap is already providing the equivalent of $131,981 in abatement per year, or 31.4% of the abatement of the taxes are being, it's a tax cap credit, but it is essentially, if you're at 20%, if you did an abatement and you were only at 20%, they're not getting any benefit of that 20% because the 31% is higher than the 21% that you gave. And people are looking at me like I'm nuts right now, so if you have questions, let me know. Yeah.
You say that the 131,981 is essentially an abatement, isn't it the law?
Correct.
The tax cap?
Yeah,
So
correct.
how can you define that? I
So-
mean,
so
that's
what-
not an
so what we-
abatement that
what we-
they're
what we
gaining,
were reading-
it's the law.
What we were doing wrong as a staff is we were looking at the abatement based on with the tax cap already being there. So in this case, we did not use the $419,981 number. We used the $288,000 number that included the tax cap, and then we gave you the analysis based on a reduction of that being 20% at a time over that 5-year period. But that's not how it's done. Are you following me?
Okay, so the
Because
abatements,
31% is already off the top based on the property tax caps. You're looking at me like I'm not still, okay, that's okay.
I'm trying to think it through.
Right.
So when you're giving us the visual analysis of a tax cap, then if you're recommending a 5-year abatement, instead of putting the tax bill at, I'm sorry, I'm mixing my numbers up, at 419, you're going to add the 131,981 to it, and
It's actually reduction from it.
okay, so
So let me go to the
in
next slide, and it might help.
Okay.
So the equivalent of going to a standard 5-year abatement where you're dropping it in 20% increase, when you include the tax cap number in there, instead of going 80, 60, 40, 20, essentially when you include the tax cap number in there, you have a higher percentage that you need to abate to equate to the same number of benefit at that 80, 60, 40, 20 rate. So what that means is that 100% is 100%, so 100% stays the same. And then to achieve an 80% rate, you would need to abate 86.2% of that in order to have the equivalent of an 80% abatement based on the tax cap number. And the whole reason I bring this up, I know it's confusing, but it's an educational session, so I wanted to do that because the next time that an abatement comes and we want to do this, you're going to see odd percentages, and the reason you're going to see odd percentages is this. So the 80% is at really 86.2, the 90 or the 60% is really 72, the 40% is 58.8, and to achieve the 20%, you're at 45.2%. To achieve that standard reduction when you include the property tax caps.
And I appreciate the clarification. This is really good stuff.
Okay.
Doesn't that door swing both ways, though? So that when you consider, now that we overtly are going to consider the impact of the tax cap, for the hypothetical developer to come to us and say, we can't do this project unless you abate taxes at this level. To me, it almost weakens the argument for the abatement because they're automatically, through a different function of Indiana law, receiving that 31% abatement on taxes before we even talk about a local tax abatement.
And another reason why we don't want an ordinance to try to figure all this out, it should be considered on a case-by-case basis. So your point is well taken. That's definitely a consideration for the council as part of acting on any abatement moving forward.
And by the way, I'll go on record as agreeing with our system and how we've administered tax abatements over the course of my career. I think it works well for us, and I don't know why we would change it.
I have a question, Ken. Yeah. So if I'm understanding right, the reason you have to do the extra math on that, is that just because the way the statute's written that says tax abatements have to be on the gross amount without caps?
Yes.
So then we're forced to do the math rather than just streamlining it and saying it's a net of tax caps? Okay.
So before, Ken, was it a little bit misleading? Before,
Unbeknownst
the way
to
you were
us,
presenting it?
unbeknownst to us, we were doing it wrong. So as a staff level, we were doing it.
Okay.
I guess that's my question. So it was wrong just because we were misreading the statute?
I shouldn't say it was wrong. I mean, to President Hicksonball's point, it was right, just the end of those
Right.
abatements weren't getting the credit for it because they're already getting the credit from state law.
Yeah, we were considering the
gross, not the net.
The gross, not the net. And
Right.
it's the net that really needs to be compared to the local tax
Correct.
abatement decision.
But the numbers end up, I mean, the way we were doing it before and this revised version, the numbers are the same. Am I correct in that? In
So-
other
so-
words, the
so again-
dollars abated are the same or not the same?
No, it's different. And it's different per taxing district, and the referendum throws a different level on it that we're not going to get into here tonight. So I'm just trying to do basic education, and I rely on Baker Tilly, so I don't know how much Emma is shaking her head, but that's.
I haven't seen her do it yet so
okay,
far,
good,
so you're
good,
doing
good,
okay.
good. All right.
You know what would be helpful for me, Ken? And you don't have to do it tonight, but it'd be interesting to take one of our current abatements and lay it out in this new way compared to how it was laid out before, just to have a side-by-side comparison. That might help me, English major,
Right.
understand it better.
So again, going back, and I'm using the Avalon as a project, they were given a standard, I believe a standard 3-year abatement, if I remember correctly. And so the fact that the tax cap is already providing a 31%, I think, benefit, and that third year of the abatement's at 33%, that means they're only getting an additional 2% over and above the cap as part of that. But we're happy to put together
I
that. and
guess I kind of
evaluate
like to, because I like it, I'd like to see like the visual
Right.
comparison,
Got it.
just in a little spreadsheet.
Yeah,
Okay,
not a problem.
thank you.
Yep. And then it gets worse if it's an apartment. So again, you're capped at 1% for a single family, 2% for the apartments, and 3% commercial. You just went through the commercial, but remember the tax cap impact is higher as you go through those levels. So the apartments is actually a higher level. So the tax cap is a $228,000 benefit, if you will, which represents 54.3% that they're already getting benefit of from the tax cap. So any abatement that you do above that has got to be above that 54.3% threshold in order to provide benefit for them. So in that same scenario, using that 54.3%, the percentages to equal and that 80, 60, 40, 20 that we talked about would be 91%, 81.7, 72.6, and 63.6 to get that same corresponding benefit that we had allocated previously. So again, it changes based on the taxing district, and then it changes based on the type of property tax cap on the property. So those are the things to keep in mind when we're considering tax abatements. All right, so next we're moving on to the TIF section, unless there's more questions on tax abatement.
Any questions for Mr. Prince on tax abatement?
No?
Thank you, sir.
Thank you, sir.
Good evening, everyone. My name is Emma Adlam. I'm a director with Baker Tilly, and with me is Sam Schrader, who has done a lot of work on this presentation as well. Like Ken said, we're going to cover tax increment financing. We'll do just a little bit about TIF mechanics. I know I've done something similar of a presentation to you in the past, so I apologize if you've done TIF 101 before, but stop me if any of these concepts are new to you. So talk about TIF mechanics and then the relationship between TIF and those overlapping taxing units. Then talk about property tax caps and the impact of TIF. And then just a broad overview of the consolidated TIF area, just high level to kind of kick into what Ken's going to talk about next. So on the screen is an illustration of the life of a TIF area. So when you're creating a new TIF area, it's a new allocation area, the assessed value at the time you're creating that TIF area does not get captured. That continues to go to the overlapping taxing units, and TIF is really just capturing the growth in assessed value due to that new development. So your land value, when you create the TIF area, keeps going to the overlapping units. You capture the increase in value due to the building over the 25-year period of TIF. And then once you hit the expiration, all of that assessed value is released to the overlapping taxing units. So it doesn't take away assessed value from overlapping units. It really just postpones when they would realize that assessed value growth. Looking at kind of TIF and the relationship with the overlapping taxing units. A lot of numbers on this screen really kind of builds off of what Ken was talking about the different taxing districts within the city of Mishawaka. So your your consolidated TIF area is in 4 taxing districts: Mishawaka Clay, Mishawaka PHM Schools, Mishawaka Harris, and Mishawaka Penn. So when you think of overlapping taxing units, picture a building. That building is located in the county. It's also located in the city. It's also located in the school district. And each of these taxing units build upon one another to have the total tax rate of that taxing district. So for your TIF area, kind of starting at the top, all of the parcels are within the county, the city, the boundaries of the airport, and also public transportation. So with every property within your TIF area pays tax rates pays those tax rates. Now, depending on where the property is located, there's a different tax rate for the township and the school and the library. So that's what this 4 breakout is down here of, depending on the taxing district, you're capturing the tax rate from the South Bend schools or, School City or PHM schools, really depending just on where that property is located. Yeah, absolutely.
Sorry. You probably were going to say it, but I want to make sure before you go to the slide.
Yep.
What she has identified at the end of each, or what Sam has identified, I don't know who put the slide together. But in each of these taxing districts, you see at the bottom of each, the revenue that comes from each of those districts. So you can see the vast majority of revenue, over $12 million, comes from Mishawaka Clay, and only roughly, 10% comes from the school city of Mishawaka section. So when you look at the consolidated TIF area, which generates about $20 million a year, roughly $2 million of that is located in the school city of Mishawaka's taxing district.
Yep, absolutely. Absolutely. That was where I was going. So, before I move on, do you have any questions for me of the relationship between the taxing district or the different components within the consolidated TIF area?
Sorry, I just need to clarify something. With this illustration, is this a piece of property, or is this
This
all?
is looking at the tax rates
Based on,
2024. These are 2024 tax rates. So a single piece of property will pay, all of them will pay the top amount. So everyone pays the county rate, the city rate, the airport rate, and the transportation rate. So everyone pays a baseline of $2.77. And then addition to that amount, it depends on where the property is located. Is it in Penn Township? Is it in Harris Township, Clay Township? and you add in the different tax rates for the townships and the different school tax rates, depending on where you're located, to get to that total tax rate of, say, for Mishawaka Clay, it's $4.35, or does that help?
I understand that part. What I was confused about, and now I understand what it is, this is the totality of the TIF.
Yeah, so I'm showing the breakout. So then, as Ken pointed out, Mishawaka Clay Township, which is South Bend Schools portion, generates about $12.66 million in TIF revenue. So really a large portion of the TIF revenue generated from the consolidated area is in the Mishawaka Clay taxing district. Mishawaka Harris taxing district, the estimated TIF is just under $4.4 million. Mishawaka PHM schools, $3.7 million. In Mishawaka Penn Township is about $2.3 million of TIF revenue, to kind of understand the breakout of your consolidated area, how much is located in which taxing district.
So what is the, excuse me, the total assessed value of the consolidated TIF?
I can pull that up for you. I don't have it written down. I can pull that up for you and send it to you.
Just curious, because it'd be helpful to have that maybe on there.
Yeah,
And then
well,
the percentage of,
Well, I did write down, I just didn't add up the numbers. Mishawaka Clay, and I'm doing, some of my slides are based on taxes payable 23. So this is pay 23, Mishawaka Clay, 380,643,000 is captured assessed value. Mishawaka PHM, just over 112 million. Mishawaka Penn, just over 80 million, and Mishawaka Harris, just under 152 million.
that's helpful. Yeah, thank you very much.
So I don't have those numbers added together, but
That's
to give
okay,
you a
that's
sense.
helpful.
So to get into the conversation of TIF and overlapping taxing units, the question is, does TIF take away money from overlapping units? The first concept is the but-for test. So if you think about the Mill 2 project that was approved last year, that the developer needed the TIF incentive to make that project work financially. That if the TIF area wasn't created and the bonds weren't issued, that project would not have come. So you're not giving up TIF revenue because that project wouldn't have happened if that area wasn't created, that's what we call the but-for test. Second is the TIF doesn't capture the assessed value indefinitely. It's a set period, so it just postpones when those overlapping taxing units receive the benefit. And then once that assessed value is released, it puts downward pressure on tax rates as the assessed value of the overlapping units is increased. Focusing on the relationship of TIF and schools. The first thing to note is that a large portion of school funding comes from the state. The schools do have an operations fund and debt service funds, and those funds are levy limited. And just like the city, when you set your budget, every unit of government has a maximum amount that you can levy. And the state controls how much that maximum amount can grow each year. So even if you didn't have any TIF and all of that assessed value was part of your tax base, you're still at your maximum levy. That's controlled by the state. So, there's no, we're going to get into circuit breaker, but other than circuit breaker, there's no dollar impacts of the TIF capture because of that maximum levy of school corporations. There are, focusing on, schools, they talk about TIF a lot, and there's sometimes, they kind of butt heads. It's really property tax caps that hurt school funding. And if you think about hurting Mishawaka's funding as well. Everyone is losing from those tax caps. One benefit that schools receive is that referendum rates that Ken alluded to are, it's not captured by TIF. So both Mishawaka schools and South Bend schools have referendum rates in place, and the TIF assessed value is applied to those referendums. So just to give you a little context, let me flip to the right page. Looking at mill phase one, think about that's in a TIF area. Their pay 24 tax bill is just under $684,000. But because it is there's a referendum rate in place, they pay almost $95,000 of their total tax bill goes towards the school for their referendum rate. So just thinking about kind of the benefit of as there's referendums in place, you can see Mishawaka schools, as we pointed out earlier, less of the TIF is in School City Mishawaka, but about just under 84 million of assessed value is applied to the school city's referendum rate. South Bend schools, it's just under 376 million of TIF assessed value goes towards those referendum rates. So I'm going to get into the concept of property taxes and property tax caps and TIF. So we've done some illustrations of what is the impact, hypothetically, if you were to have released $10 million of assessed value in each of the taxing districts, what would that impact have looked, what would that have looked like on the overlapping taxing units? Because like I said, everyone's at their maximum levy. You don't really get increased dollars by releasing your assessed value, but you indirectly get a reduction in circuit breaker losses. Because as you release assessed value, to generate that same levy, your tax rate needs to be lower. And when your tax rate is lower, there are less circuit breaker losses that are distributed amongst the county, the city, the school, the library, et cetera. So it's weird to say you almost have increased revenue because you have reduced losses. And that's what we're trying to illustrate here. This is Mishawaka Clay Township. If we released, our redevelopment commission released $10 million of captured TIF assessed value, what would that do to both the TIF and to the overlapping units? The TIF would have lost about just over $400,000 in TIF revenue collected by the redevelopment commission. But other units of government would see essentially increased revenue due to the reduction in circuit breaker losses. So Mishawaka City would have received $87,600 more in revenue because their losses would have decreased by that much. And the kind of overlapping units collectively, if you add up the county, the township, the library, the city, the schools, collectively circuit breaker losses would have decreased by about $167,000 compared to the $406,000 of TIF loss. The other, about $240,000, you might wonder what happens to that. That's other taxing units do see some circuit breaker relief, and homeowners do get a reduction in their property tax bills. But if you focus on the majority of the impact, Mishawaka City, because of the higher tax rate, would have seen the biggest benefit of a reduction of about $87,600 of circuit breaker losses. So this essentially, kind of one way to think about this is, a lot of communities like to say, a lot of schools, for example, say, well, we pass through more assessed value, release more assessed value. Well, it's not a dollar for dollar impact. That you might be giving up $400,000 of TIF, but the benefit that the school corporation would receive, would be, I think we're showing about $20,000, maybe $30,000 of what the benefit would be to South Bend Community Schools for this particular taxing district. That same exercise, this is what it would look like for Mishawaka PHM School taxing district. Really, it's pretty minimal. The city would really only see the bigger impact of their losses would have decreased by just under $89,000. Overlapping units collectively about 151,000 of the units that make up this taxing district, but the TIF would have lost about $320,400. Mishawaka Penn Township, once again, kind of similar graph. TIF loss would have been just under $300,000. The overlapping taxing units that make up this district would have seen an increase in net revenue of about $166,400. Finally, Mishawaka Harris, if you pass through $10 million of assessed value, the TIF loss would be about $210,000. The overlapping units within this district would have seen increased revenue of about $123,000. So the big picture, kind of putting all of those pieces together, the big picture is what if you didn't capture any TIF in the consolidated TIF area and you just released all of that assessed value? You would have lost about $21,580,000 of TIF revenue. Mishawaka City would have had increased revenue of about $4,780,000 in reduction in circuit breaker losses. Mishawaka Schools, about $1,160,000, PHM, 748, South Bend Community Schools, about $1.6 million. Compared to losing $21.5 million of TIF revenue. So just kind of showing how that impact is spread amongst the overlapping taxing units. Because I think that's a conversation that a lot of communities have, especially between schools and redevelopment commissions, about the impact of releasing assessed value. But, instead you could give grants to school districts instead, and that's almost a bigger bang for your buck dollar-wise, is maybe just giving grants directly instead of releasing assessed value. So then I think I have 2 more slides left of just looking at the consolidated TIF. So this, it's based on pay 23 information. This looks at the shaded area is each of the shaded area is a taxing district. And so all of this revenue combined is the estimated TIF revenue for the consolidated area. So Mishawaka Clay Taxing District is the big teal section. The red above is Mishawaka PHM Schools. The probably brown or maroon color is Mishawaka Penn Township, and then the yellow is Mishawaka Harris Township. You do see towards the end, you see it kind of stair-stepping down a little bit. And that's because portions of the TIF area expire before the whole TIF area expire. Depending on when your TIF area was created and when it's expanded, the law at the time of your creation and expansion, your different pieces expire at different times. But this gives you a sense of the TIF revenues collected, allocated amongst the different taxing districts. And then in gray, we have the estimated sewer contribution, since that really comes off of the top of your TIF revenues and your planning. So we have those columns on this chart as well. And then lastly, just a summary of the outstanding obligations for your TIF areas. You have bonds issued in 2015, payable from solely consolidated TIF. You have about $690,000 of principal outstanding. You have lease rental bonds issued in 2021, payable from the consolidated TIF with a property tax backup. The outstanding par amount is about $37.5 million. You have lease rental bonds outstanding for your sports facility project, and that's payable from a combination of revenues, hotel, motel tax, sports facility TIF, from that particular TIF area, company operating revenues. But you do have your consolidated TIF as a backup should there be a shortfall in those other revenue sources, with an ultimate property tax backup. And then finally, Ironworks Phase 2, that is its own allocation area, and you have about 10.3 million in bonds outstanding. It's payable from that allocation area, and the developer has also set minimum taxpayer payments for the debt service as well. So that wraps up the TIF portion. Back to Ken.
Any questions for Emma? Thank you, Emma, and thank you, Sam.
Okay. Mayor, is there anything you would like to add at this point in time? Was that a no? Okay.
That was a no.
On the subject is a dirty word downstate when it comes to Indiana General Assembly. So every year we have to defend TIF legislation that we think is bad. When you think about TIF in Mishawaka, most of what you see is a result of TIF. Mishawaka would be nothing what it is today without TIF. When you think about what started Mishawaka into the TIF business was University Park Mall. And it was an original legacy TIF. Now it is limited. And so when you think about that growth north, and then ultimately what the growth north has provided for our downtown and the rebirth of our downtown, it's been transformational for Mishawaka. But every year we, as I say, have to defend. So just recently, and what we think will happen again, is the biggest school impacted by TIF is South Bend Community School Corporation. So now the General Assembly every year is trying to have a voting school board member. We have a school board member on our redevelopment commission, non-voting, from School City Mishawaka. But what would happen would be a voting school board member would be on, and so that's great. We have 3 school corporations within our TIF. Which one do we pick? Well, we have to pick the biggest one. So that would mean we would have a voting member from South Bend Community School Corporation on the Mishawaka Redevelopment Commission. Counties are trying to get into it now. So the Association of Counties is looking to have a county member of the Mishawaka Redevelopment Commission. So we're trying to make sure that we promote Mishawaka Council's decision-making and make sure that you have the same voice and an increased voice while we make sure that we are representing our citizens, not the neighboring community citizens, because we think it's you who have the most important voice at the table and our citizens. So we will keep doing that. I may be calling on many of you as this effort goes on and depending what comes up in our lobbying efforts. So AIM certainly does an outstanding job of representing us, but oftentimes our legislators need to hear how it impacts us individually. So I may be calling on you in the future to share our experiences here. Thanks.
Thank you, Mayor. So the slide that you see up on the screen is the purple area identifies the city's consolidated TIF district. So as the mayor mentioned, our legacy TIF is associated with Grape Road and the University Park Mall and that commercial shopping center, which generates the majority of that TIF revenue. When I started with the city, we had 3 separate TIF districts. We had the North District, we had the central downtown TIF district, and we had a southern TIF district. When we looked at our issues with Uniroyal, the need to fund the demolition, at that point in time, the assessed valuation in the downtown was actually decreasing, not increasing, so we couldn't take on any debt because it wasn't generating any revenue. At that point in time, the council agreed to amend the North District to come down, and the business owners in the North area agreed to let that TIF district come down. So we had, at that point in time, 2 TIF districts. The Northern TIF district and the Central TIF was combined, and that is what paid for essentially the demolition and cleanup of the Uniroyal properties. As the mayor indicated, Mishawaka would be an entirely different city without TIF. For those that may be listening online, it paid for the infrastructure associated with Edison Lakes. It's paid for wastewater improvements. It's paid for the underpass. It paid for the improvements on the southern underpass in addition to the north underpass, and so on and so on and so on. So, and we will talk about some of the more recent projects. So in 2014, the state of Indiana said, you know what, we have enough of legacy TIFs, and we're going to have them expire. So what they said at the time is if you don't have any debt associated with your TIF district, it will expire immediately. Otherwise, it's going to follow the amount, the financing period for the debt that you have on the district. So in 2014, we took the opportunity, because there was also other changes in state law that affect how you have to modify the area, the collection area associated with the TIF. So at that time, and I think the news article downstate was Mishawaka goes all in on TIF, because what we did at that point in time was, in working with legal counsel, was it didn't make sense to have multiple TIFs. We were going to consolidate it into one TIF. We identified the capital improvements, the areas that we needed infrastructure improvements, and put, so a lot of our TIF district that you can't quite see in the purple, but are many roads, so it doesn't collect any of the revenue along the roads, but the roads are included in the TIF district to make sure that we potentially had a funding source to do what we knew were needed road improvements over time. So when you look at closely at our TIF map, it looks a little like spaghetti because of that need to put those projects in the area, but that we weren't looking to collect any revenue from them. So you'll see Lincoln Way, for example, is in the TIF district that extends to our eastern city limit. We're not looking to collect TIF revenue out by the Twin Branch area, but we were potentially looking at utility improvements, sidewalk improvements, other improvements that made sense along that corridor of why it's included. Also in 2014, as I indicated, we didn't have any debt at all at that point in time on our tax increment financing district. So had we not done anything, the entire TIF would have expired, and we would have lost the ability to do it. So at that time, we did a $1 million TIF bond that went to Battelle Center improvements of that $3 million project that we did, very specifically to extend the maximum of 25 years. So the number that Emma and Baker Tilly is referenced in 2039 is associated with, in 2014, we have a 25-year bond, so that's why that overall, the entire TIF goes away in 2039. So the first TIF starts to expand or expire in 2033. So between 2033 and 2039, based on when those TIFs were established, they're all going to go away. So that was the slide that Emma represented. The stars that you see on the screen, so when you look at the 3 stars, one for the Mill Phase 2, one for the Mishawaka Fieldhouse, and one now for Grandview, are all separate TIF areas. So we now have 4 different TIF areas. We have the consolidated TIF, and then 3 project-specific TIF districts. And the reason we have those project-specific TIF areas is because the amount of funding provided between now and 2039 weren't sufficient to get those projects done, and we need the additional time and the additional capture period to go back in order to fund the bonds associated with those projects. As we move forward, in the mayor's state of the city, he identified Midtown Mishawaka. That is another project that might have another TIF, and as we move forward, we will likely, for larger projects that have higher densities, it does make sense to create additional TIF districts. The question is just when they would come forward. So we look at TIF as a viable tool moving forward, and between now and 2039, we have a lot of things to figure out. So that's kind of the backstory on that. And I apologize for those online because I didn't create slides for these, but everybody, when you came into the room, should have picked up the TIF cash flow analysis between 2023 and 2033. So when I first started doing this analysis, we only did it in 5-year increments. And then we always wanted to see beyond that, beyond that, beyond that. And so right now, this is a 10-year projection. Believe it or not, the first page I want you to look at is the very last page of the packet. So when you look at page 12 of the packet, I think it's very important to note that when we hit COVID in 2020 and we worked with the council, and we were very concerned at the time that the trades, because of everything shutting down, weren't going to keep busy, and we knew the construction trades, it was very important to us that we kept the construction trades busy, not like, if you look at the Great Recession, one of the reasons housing pricing has gone up so much is we lost a lot of home builders as part of the Great Recession, and our thought process at the time, having never experienced a pandemic, was that the construction trades were going to get slow, and one of the ways that we could help keep them busy was to float a TIF bond, do construction projects that we had on our capital improvements plan, and move those forward. So we did roughly $45 million of TIF bond funding that included many projects that are listed on here, and we have them identified. But why I asked you to look at the last page is since between 2018 and 2024, we've spent $184 million on various projects, and I didn't ask the controller's office to go back and dig it in so you get those consolidated reports. What I did was I went back to the projections that I had done for the cash flow analysis and put dollar values associated with them per each project. The whole point of this exercise was just to give you an idea of the projects that have been funded through TIF. It wasn't relative to get an exact number. If you ever want an exact number for projects, it's actually difficult, but we'll do it for you. But I use the example of City Hall, for example. We used utility bond funding. We used separate funding for different components. Every project that we do, it could be done as part of different projects. So we bid the parking lot separately from the building on this project, and we did utility improvements through a separate project. So even though they're relatively associated with this project, they had 3 different bids associated with it. So it's very difficult to come up with an exact number depending on the project. Some of them, like a park improvement, that's very easy to identify. Other projects are more complex. So when you look at these numbers, this is just a windshield analysis of that $184 million of funding. Need to go back now. There we go. So you have $184 million, and I will say during that period of time, our collections ranged from $18 million to a little over $20 million. So in that period, why that number is $184 million is because of that TIF bond and the spending that was done during that time. So it's more than just during that period of time, we spent more than what we collected because of the TIF bond that was issued. Does that make sense to everybody? All right, but now we've got to pay that bond back. So when you go back now, you can look at the back sheet on your own time, go to the front page. On page 1 shows the ongoing debt that we have and the payments associated with it. The other thing I'll note is that in putting this together, kind of like your home checkbook, only it's much larger increments and it only comes twice a year. But the TIF payments only come in essentially in December, your fall tax bill and then your spring tax bill. So typically the spring is larger than the fall tax collection, but overall, what we have to do in terms of managing the TIF district is to make sure we have cash on hand to pay for it. So why we have 2023 numbers on here is we don't get our next paycheck, if you will, until the spring collection. So that's why the 2023 numbers are listed there, is we had to account for the cash coming in to pay the bills until we get our next check, which I believe will be in June. Everybody following me? Yep. All right. So going through the different the different debt that we have associated with the TIF district, we have the Patel Center bond issue. That's what enabled us to continue the bond till 2039, or the TIF district till 2039. We have the current annual wastewater commitment. When we last adjusted wastewater rates, we started the reduction process of that wastewater commitment. So when you looked at that last page and that $184 million of TIF that were spent 25.2 million of that went to subsidizing wastewater rates as part of our use of TIF funds. So currently, we do $3.36 million a year that comes immediately from TIF that goes to help subsidize our wastewater rates by paying for the infrastructure associated with the wastewater expansion and the ongoing improvements. So that goes immediately into the wastewater budget. When we last adjusted rates, what we indicated was in 2025, that drops to $2,760,000. And what we're showing in this cash analysis is every 3 years dropping that another incremental period, so that in 2033, when our TIF starts to expire, that wastewater charge would be off of the TIF, because ultimately in 2039, it's going to go away completely. And what you noticed in the slide that Baker Tilly put together is with that sliding scale, it provides a uniform level of capital improvements by dropping it in this way, rather than a sudden drop where you suddenly have an X amount to work with, and then you would remove significant ability to do that by not dropping it in this fashion. So this is a discussion for another day. We just wanted to point out what kind of that current vision is that we are going to be suggesting to you in the future, but that's to be worked out another day. And then the Mishawaka Fieldhouse is, again, developer funded, is a single site TIF district, so I didn't include this in the projection because all the TIF revenue being generated is going to the project. The same with Mill Phase 2, and it's not listed here because it wasn't done at the time when I presented it, but Grandview is also another single site TIF. So all the revenue generated is going into the project, so we're not doing an analysis of how it's being spent. It's all going back into the project. Then we have the stimulus bond issue that was done. That we talked about that was with COVID. So that payment is roughly $5 million a year. So that goes off. The last payment, I believe, is in 2033. So again, we did that very specifically to time when the TIF was going to be dropping to recapture our ability to do projects at that point in time based on that debt payment going away. And then the 2024 bond issue is just a placeholder. If we decided to do another bond, we had Baker Tilly run numbers, but right now the interest rates are not favorable to do another bond. So we are not currently proposing that out there. But if we had, for example, an economic development project, a specific capital improvement, we still have bonding ability located within our TIF district that we can go out and get a project done. So that is really a placeholder more than anything. So if you turn to page 2, we've broken these categories into different areas. So you see the CSO storm sewer, a very minimal amount, $175,000 a year. In 2023, 125 in 2024, and 275 is going from TIF into that wastewater. And again, that's above and beyond the commitment to wastewater rates of that $3.36 million that we're currently paying. I've also identified the other projects that we have that could be paid for by TIF associated with it, so that that is all located but unfunded. So the other projects below each category are the projects that we know we have on our capital improvements list that aren't funded, that aren't listed, that aren't in our current cash flow projections. So the big one you see there is the trunk sewer on Capitol Avenue to Douglas Road. That's a $40 million project. How do you get a $40 million project done going through there? We would either have to allocate significant TIF revenues to do that, or potentially a large project comes in and then would help fund that project. That's a huge lift to provide sewer to Capitol Avenue in that development area. So going to the Judy Creek well field, the regional recreation facility, currently what we have funded in here is the lift station and Veterans Parkway extension. This does not include currently the future extensions up to Cleveland Road and other projects associated with that, but they're all listed below it. This is, again, just to give you an idea of the cash flow coming through it. Turn to page 3, you have the downtown projects. I should have noted earlier, the highlighted ones in yellow are the ones that were funded through the bond issuance. So essentially at the end of this year, all of that yellow will be removed because all the bond money will be spent by the end of this year. So next year, when you see this cash flow analysis, it will not have any yellow highlighted areas because all the funding from that bond issuance will be gone. So the projects we currently have out there, the Front Street, the Buter project, the cafe, the rink, We're down to the last 300,000 of that. We're essentially have some minor repairs and some money that we're holding from that project until the developer finishes it. So that was a $21 million project that has $300,000 left. The parking lot for Burns and for the former Burns facility and for Battelle Park, that is being funded through the bond issue as well. That should start construction in the next month. And then you have the other projects that aren't highlighted that, again, are included in the TIF district that we currently have funding. I'm going to flip through this because I know we've spent already over an hour tonight. So, but if you have any questions on specific projects, let me know. I'm happy to stop and talk about them. So road widening and transportation enhancements, when you look at page 4, really a lot of these are associated with federal aid projects. So one of the things that we use TIF for is to leverage other funds. So federal aid projects, roughly once every 3 years, we get an allocation of funding. It's what's paid for 12th Street. The next phase of 12th Street is scheduled. So you see the lead up to 2027, 2028 for Phase 3B widening. And we're currently looking at that. And then we're looking to move other projects like McKinley that has been allocated here. The mayor talked about in his State of the City of reprioritizing those funds to Union Street for the Union Street widening because of the traffic congestion that we're currently experiencing going south toward Dragoon Trail on Union Street. These are the funds that are associated with that. And again, if we did not have TIF, we would have to figure out some other way to fund this, whether it would be seated or otherwise. But we get 80 cents on the dollar when we use a federal aid project. So those projects also cost more, and then we have the design associated with it. But part of it is if you can get half your project paid for using federal dollars, you want to use those dollars where you can. So we continue to apply for federal aid projects, but as you can see, these are the projects that are currently queued, but we have a ton of other projects of worthy transportation projects that we could do with TIF if we had the funding. So with that, we'll go from page 4 to page 5. So one of the emphasis that we had in the bond issue that we did for the stimulus in 2020, 2021 included a number of parks. So we have to finish up those parks. So you may have just saw at Crawford Park, the sod just went down. That should open in a month for Memorial Day at least. So the mayor and Phil can work that out, but ultimately it's getting very close to being finished. But that's why you see dollars allocated here, because when I did this in December, that's how much of that project was left that had to be paid associated with it. So a good deal of that, when you look at Crawford Park, that $800,000, a good deal of that has already been spent based on the construction progress that occurred between December and now. But that gives you an idea. And then Normain Park improvements, one of the projects that we hope that our Park Foundation is right now in the process of fundraising. So we have some big donors coming in, and we want to be able to potentially match the funds for Normain Park for the Miracle Diamond going out there. So we've identified that $1.7 million for that. That would likely be the maximum that we would be spending on that project. That might be less depending on how they do fundraising. One of the things, if they raise $3 million, our goal is to do more of that project. Like any project, it's going to be phased. So the base Miracle Field, the base phase 1 is $1.6 million. And we believe we have currently over $1 million. The Park Foundation has over $1 million raised for it. So we're really hopeful in the next 3 months that they're going to continue with that fundraising, raise a lot of funds, and then we would be able to allocate funds to that project. So that's what that is identifying. The Riverwalk has built the majority of our Riverwalk and trail projects. So Cedar Street to Marvin's Garden is now essentially complete. Again, they have some cleanup work to do, so we're holding some money for that. The Riverwalk, the restoration, the bank armoring project is underway right now. So the work that you saw going underneath Main Street, adding the rock, putting the grout in. This is going to redeck the bridges going to Cam Island. All that's coming out of those bond funds. And that will be done later this year. The bridge decking won't be done until after Cam Island Fest. We didn't want to mess up Cam Island Fest this year. So, and then the Cedar Street Bridge match, that is a little over $1 million that we've spent on that Cedar Street Bridge match, but that's a federal aid project that's doing that project as well. So that's the park and trail projects. The building industrial projects on page 7. By far, the biggest number is the fire station number 2. So as you recall from previous presentations, when I originally threw a wild guess in of what fire station number 2 would cost, I knew fire station number 4 in 2012 was done for $5 million. I plugged a number of $7.5 million in, just as a placeholder. That'll teach me to ever do a placeholder number again, because the real cost of that project is about $15 million. So we are using $7.5 million from the bond issue, and then $7.5 million out of cash to pay for that project. And so that's what this represents, is the funding of that project as part of that. So, and obviously I've broken it into different components. So you have the basic building construction that Wigand is building is roughly a $12 million project, but we had to build the road, we have to do the FF&E for that project. You had to pay the architect and engineers to design the building. You have to pay for the generator, or we pay for the generator separately to save money. So all those costs go into that $15 million number. You go to the next page, page 8. So if you recall, when we originally initiated the bond issue, we had more money allocated to the Cedar Street motor pool, really for cleanup, and we've put that project on hold. But what we are doing is acquiring properties around it. So we've just acquired the property that's located to the south of the hardware store. That will be coming down shortly. There's 2 on the north side of the hardware store. We've acquired one of them. The other one, we have a purchase agreement, the person that owns that. The other one is having a hard time finding another place to move to. So until we have the other property, they're basically connected by a common driveway. We're not going to do demolition until we have both of them. And we still haven't heard from the hardware store, but that's kind of the progress that's occurring for that. And then the other projects that you see that are just kind of property acquisition and soft cost include our fees that we pay to attorneys and consultants, and our various demolition projects. The comp plan update, we've included some dollars for that, and other redevelopment costs. So when you turn to the next page, on page 9, at the time that we did this, we had $12.9 million left of the bond issue. Again, this is from December, so if you can imagine, we've had multiple million-dollar payments that we've made for the fire station that have come out of that. So again, by the end of the year, these funds will be gone. And then on page 10, you look at the total dollars that are committed. And so again, the point of this is to identify your cash flow and what you have that's coming out of it. And I just noticed I got estimated wrong, so I printed the wrong sheet out, because we do have confirmation of what that number that we received, that 10.2, where it says estimated revenue in the middle of the page on page 10, right below cash balance, we did receive that $10 million distribution from the county. So the green number, the cash difference between all the projects that we talked about, our debt payments, our commitment to wastewater that we had outlined, the green number, so in 2023, essentially, basically that'll be May of this year, we should have 1.7 million in cash. By December, we only have a little under $1 million in cash. And then 2025, based on the projected revenue that we're receiving, we're only going to have $6.6 million available for new projects. And think of what we have on the horizon right now. So in addition to what we've already allocated, we don't have Dodge funded right now. So when I came to this, and I realized a number of you weren't on the council previously, but when I came to the council previously, I would say that this is pushing Union Street further down. This is pushing Dodge further down. This is what I'm talking about, because ultimately we believe that both the demolition costs and building the infrastructure to redo Dodge is roughly in that $12 million range. So that means to complete that project will take multiple years. We know the demolition is going to take multiple years, but this gives you an idea of the available cash and the limited amount of cash that we have relative to moving projects forward. So through 2026, if you pull $12 million out to do the Dodge and the associated infrastructure, in addition to Dodge through 2026, that only leaves us $3 million to do other projects. That obviously gets better as you move forward. But if you think about it, we spent $188 million in the past 7 years. Moving to 2033, we will only have $94 million to spend for all of our future projects. All those other projects that we had identified in each of these categories, that is all the funding that we have available for TIF moving forward. And why I mention that is it just stresses the importance and what we do with TIF. And the mayor and I were just talking earlier that in 2039, between now and 2039, we need to come up with a plan on how we're going to do capital improvements, because with property tax caps, we rely very heavily on TIF to do our capital improvement projects. And you're going to have to figure out a way, we collectively are going to have to figure out a way by 2039 on how we're going to do capital improvement projects, because the consolidated TIF will not be there to do those projects. So with that, and then just for point of reference, so every year we have to confirm to other taxing units that we have the need for the TIF. So on page 11 at the end, the other projects that I identified as not being funded, that's $510 million of projects that aren't capable of being funded, and why we need that TIF moving forward. So, so that concludes the presentation on TIF and the cash flow. Thank you for your attention. I know this is, I said to my wife that this is what I'm presenting on tonight, and I think the comment was, how are you going to keep them awake? So, so I appreciate the attention and the questions and everybody that came out tonight. So,
Thank you as well. Job well done. Mrs. Volker.
Just a question about revenues. In the TIF, I'm assuming you take into, that you consider the value, the increasing value of the TIF. You know, how do you come up with your cash flow, those numbers, your income and the TIF?
right, so that's
are
a
you
good
being
point. So if you go back to page 10,
And are you being conservative about it? I mean,
I am not being, I'm being, I don't want to say accurate, I'm being slightly conservative on those numbers.
okay, I'm on
So,
10.
so when you look at the revenue of what I projected per year is $20 million.
Right.
We think we had an exceptional year last year, because so these numbers, when you look at the last 4 years, in 2020, the total TIF revenue was $18.4 million. In 2021, it was $20.7 million. In 2022, it was $19.6. And then last year in 2023, it was $21.8. So yes, if we have 21.8 moving forward, you know, we will have that extra roughly $2 million a year that we can put to capital improvements. And if you take that out to 2033, that would be another $20 million on the $90 million that I referenced. So, and again, we continue to do improvements. There continues to be projects. So we think there's a potential for that assessed valuation to increase. What we're not, as the mayor indicated, you know, we had the big box appeals that significantly impacted our ability and reduced our revenue coming in. So we have to be slightly conservative when we look at these numbers. So that's why we use $20 million as that number moving forward. But it's also consistent. You know, part of my fear last year was if we had a particularly good spring collection, if we didn't have a good fall collection, let's say it was $2 million lower, we'd be in the red, and then we'd be looking to delay projects moving forward. So it's a balancing act.
Okay, thank you.
Mr. Pioli.
Thank you, Mr. Hicksonball. Thank you both for all this presentation, and it helps me and maybe my fellow council also. Can we have copies of your PowerPoint?
Yes, so tomorrow
emails?
we'll send copies of both PowerPoint presentations as well as the TIF cash flow. So
Thank you. That would help.
Mr. Carroll.
Thank you. I'm looking at Baker Tilly's website for this, so I don't know if it's a question to you or Baker Tilly or maybe both, but it seems like other communities are using residential TIF to encourage owner-occupied in the city, and I really haven't seen anything in the short term, long term, or in the past. Is that something that makes sense for our city? Is it even on the radar?
So owner-occupied TIF, is that correct?
Residential TIF districts to encourage owner-occupied housing projects. In
So-
this one, it was a Napanee project. It was
Yeah.
almost $3 million of TIF to create an entire neighborhood.
Right, so the issue is projecting the number of houses. So last year in the city, I believe the number was 53, the new houses that we constructed. So what, we have not contacted any developer, nor has any developer contacted us about using a residential TIF to build a neighborhood. But part of it is, we're talking about owner occupied, so you're already talking about areas that are in that 1% area. And then you're talking about somebody has to cover so let's say it takes $2 million to build the infrastructure for a 100-lot subdivision. You need that $2 million, so how many houses are they going to build to pay the debt associated with that? And so how Napanee had to do that is they have to back the bond in terms of funding that residential subdivision that may or may not, depending on the housing, there had to be a developer, I would think, to back that bond on the back side of it to fund the necessary infrastructure. So in my personal opinion, that tool is meant much more for rural communities who are desperate to build housing, who are willing to use public dollars to build infrastructure for new single-family homes. To me, if we want to incentivize homeowner renovations, it might be better to look at some kind of an abatement that goes to the homeowner than it would be to build that new infrastructure. Because at what point do you say, what's the developer's responsibility and what's our responsibility in terms of building that infrastructure?
Thank you.
Other questions for Mr. Prince?
I'm sorry, Emma, did you have anything you wanted to add on that? Okay. Sorry.
Well, again, thank you for the work that went into this. Job well done, as always.
Thank you.
Thank you, Mayor Wood, as well. Our friends from Baker Tilly, Sam and Emma, thank you again for the work that you did. And I guess at this point, I have been very rude to my friends from the Redevelopment Commission. Folks, anyone from the Redevelopment Commission have anything that you want to share with us? Bill Pemberton, I'm surprised. That's not like you. All right, well, again, thank you to everyone. Any additional questions or comments from the council? Then in that point, we'll go ahead and conclude this evening's proceedings. Thank you, folks.
Thank you.
Thank you.